Welcome to the Deep Dive, the show where we break down the essential but often really misunderstood machinery of the financial world.
That's right.
Now, you've probably heard the term futures contract a million times, but today we're not just going to define it. We are going straight into the engine room.
Right into the
We
gears.
want to understand the machinery that really drives the modern derivatives market.
And that machinery, it's so much more complex than just a simple promise to buy something later. Today, we're really focused on the foundational architecture of exchange-traded futures.
The bones of the system.
The bones, exactly. And this whole infrastructure, it's a fascinating study in risk management because it does two things at once. It manages credit risk, which makes the whole system safer,
Okay.
but it also magnifies the price risk for the person making the trade, which makes it, inherently more dangerous for them.
Ah, so that's the core tension right there, that dual nature. So how can a futures contract, which is really just a legally binding promise, how is it treated as virtually credit risk-free,
hmm
especially when you compare it to a private, over-the-counter forward contract?
And that's the million-dollar question. The answer isn't about the thing being traded, the corn or the oil. It's entirely about the rules of engagement.
The rules mandated by the exchange and the clearinghouse.
Precisely. So our mission in this deep dive is to dissect those core rules step by step. We're going to start with the mandated standardization that makes these things fungible.
Okay, standardization first.
Then we'll get into the daily ritual of profit and loss calculation, what's called marking to market.
Right.
After that, the collateral system margining, and finally the essential, though rarely used, delivery procedures.
So the goal here is to get past the textbook definitions and really get our hands dirty with the operational mechanics that turn this simple agreement into a highly liquid global investment tool.
Exactly. It's the infrastructure, not just the contract, that enables billions of dollars in speculation and risk transfer every single day.
Let's unpack it, starting with the absolute blueprint, standardization.
The foundation of it all.
When most people think about a financial agreement, I think they imagine customization. In the over-the-counter, the OTC world, that's exactly what happened.
Right. You and I could make a deal.
We could tailor everything, the quantity, the quality, the date, the location. It's perfect if you have a very specific need, but that customization, it just introduces massive complexity and, critically, this risk that you might not get paid.
The counterparty credit risk.
Yeah.
Futures contracts operate on the complete opposite philosophy. They have to be perfectly uniform standardized to be traded on an exchange.
And this isn't just an administrative detail, is it?
Oh, not at all. It is the fundamental, non-negotiable first layer of systemic risk control. By making every single contract for, say, December corn identical, no matter who is trading it, the exchange creates maximum liquidity.
So if I buy a December corn contract, I don't have to do my homework on the person selling it to me.
Nope.
And I don't need to specify what kind of corn I'm getting.
The exchange has already eliminated both of those variables for you. When an exchange proposes a new contract, which is a huge process with regulators and market consultation,
I could imagine.
they have to specify 3 mandatory details that define what you're actually trading.
Okay, so what's mandate number 1?
The first is the definition of the asset itself. And it's never a loose category. You can't just say corn.
Right.
The exchange must stipulate the exact acceptable grade or grades. For corn, that's quality, moisture content, cleanliness. For something like crude oil, it has to meet very specific gravity and sulfur content requirements for, say, WTI light sweet crude.
That seems absolutely critical. I mean, if the quality wasn't uniform, the market would just fall apart, right? You'd have discounts and premiums based on who the seller was.
It would fragment immediately. Standardization ensures the price you see is for a universally accepted, defined good.
Okay, so that's the asset. What's the second mandate?
The second is the contract size. This just removes any ambiguity about the size of the commitment. Every corn contract is 5,000 bushels, period. Every gold contract is 100 troy ounces.
And live cattle.
Exactly 40,000 pounds. This uniformity lets traders calculate their exact exposure and capital needs instantly without having to read the fine print on every trade.
And even though most people close out their positions before the end, the threat or the promise of that physical exchange has to be credible to keep the price honest.
And that leads directly to the third mandate, delivery arrangements. The exchange has to specify the precise delivery locations, what are known as par delivery points, and the exact time frame, the delivery period, when the short party can deliver the asset.
So you can't just say, I'll deliver the corn sometime in December, somewhere in the Midwest.
Absolutely not. It has to be concentrated and defined, or the market would just cease to
Yeah.
function.
It's incredible. It's not just the goods that are standardized,
Yeah,
right?
sure.
Even the way the price is quoted is mandated by the exchange.
Oh, absolutely.
For someone new to this, seeing a quote for a U.S. Treasury note future, it looks like nonsense. Numbers with dashes and weird fractions. It's like a secret code.
And that's intentional. The exchange defines the price quotation format, which dictates how the price is stated and, just as importantly, sets the minimum possible price change, the tick size.
You have to speak the language to play the game.
You do. And to really understand the market, you have to understand this rigid language.
So let's try to decode this a bit. Can we kind of extract the rules here? Talk about how the exchange mandates these features for different kinds of assets.
Absolutely. The rigor is applied across the board, from physical goods to financial instruments. Let's take that asset grade rule, for instance.
Okay.
For crude oil, the rule isn't just WTI crude. The rule implementation is WTI, light sweet crude, delivered at pipeline quality at a specific place, Cushing, Oklahoma.
Wow, that's specific. And what about contract size for something like cattle?
It's, again, incredible detail. The rule is that the contract size must be precise. For live cattle, that's exactly 40,000 pounds. But it also defines the age, the weight range, and even the yield grades of the cattle.
So no one can try to deliver a bunch of scrawny cows.
Exactly. It protects the integrity of the contract.
Now, let's go back to that confusing price quote for the Treasury note. How does that rule work?
Okay, so the exchange mandates the quotation format. For U.S. Treasury notes, the rule is that it's quoted in dollars and 30 seconds of a dollar per $100 of face value.
Dollars and 30 seconds.
Right. So you see a quote, something like 131, 3 and 15. It doesn't mean 131,000.
What does it mean?
It means 131 and 31.5 30 seconds of a dollar.
So that little 0.5 at the end is half of a 30-second.
Exactly. And that's often the smallest tick size.
Yeah.
For a standard contract, that tiny movement could be worth about $15.62.
That level of fractional quoting might look old-fashioned, but I guess it's vital for precision in fixed income markets, where massive volumes are traded on these tiny price changes.
It's essential. If you're a high-volume trader, you need to know exactly how a price change translates into dollars and cents down to the absolute tiniest tick to calculate your risk.
And this whole ecosystem of standardization, by creating this universal product, it allows the market to move to the next phase of risk management, right? The daily settlement.
That is the perfect link.
Because if the contracts weren't perfectly uniform, the clearinghouse couldn't possibly manage this instantaneous transfer of value that we're about to talk about.
Couldn't be done. Standardization is the structural prerequisite for the system that eliminates counterparty risk.
Okay, let's pivot to that. This is the defining characteristic that separates futures from forwards. Credit risk. With an OTC forward, you agree to a deal 6 months from now, but you have no idea if the other party's going to be able to pay up when the time comes.
You're just hoping they're good for it.
Right. But futures, they somehow magically eliminate this risk. So how do they pull off this magic trick?
They do it through daily settlement. It's universally known as marking to market. The huge difference is when the profit or loss is actually realized.
In a forward contract, it's all at the end. It's just a theoretical number until the contract matures, and then a big lump sum payment is due.
Right. But futures contracts enforce daily accountability.
So if I'm long a gold contract at $2,000 an ounce, and today the price goes up to $2,010, I don't wait 6 months to collect that $10 gain per ounce.
Not for a second. That $10 per ounce gain is realized and transferred to your account today. The core function of the exchange's clearinghouse is to step in at the end of every single trading day, calculate the difference between today's settlement price and yesterday's, and immediately adjust the accounts of both parties.
This almost sounds like a legal fiction, but it's the key innovation. How does the contract actually get, reset?
Think of it this way. The contract is legally closed out and rewritten at a new price each day. The clearinghouse takes your gain or loss from the last 24 hours in cash, puts it on or takes it out of your account, and then treats the contract as if you just entered a brand new agreement at today's new price.
Wow.
And because that cash transfer is immediate and the contract's net value resets to zero every single evening, neither party is ever allowed to build up a massive, uncollateralized IOU against the other.
So this daily clearing, that's the reason exchange-traded futures have virtually no counterparty credit risk.
That's it.
Because that risk, that massive potential debt, is just never allowed to accumulate.
Exactly. Any potential loss is demanded in cash right away. It prevents the default exposure from ever getting big. The clearinghouse, acting as the central counterparty, or CCP, becomes the buyer to every seller and the seller to every buyer. It guarantees everything.
It's an elegant solution for the system, but you mentioned there's a cost for the individual trader.
A huge cost. It can mean a massive capital commitment under adverse conditions.
Which brings us to the margin system. To even play in this daily settlement game, you have to post collateral. And margin here means something very different than it does in the stock market.
Very different. This is a performance bond, a good faith deposit. And there are two critical levels we need to define.
Okay.
The first one is the one most people have heard of, the initial margin, or IM. This is the minimum amount of cash you have to deposit into your account when you first open the position. It's your security deposit, making sure you have enough to cover a standard day's loss.
And the second level is kind of like the alarm bell.
That's a great way to put it. That's the maintenance margin, or MM. It's a lower threshold than the initial margin. It represents the absolute minimum balance your account is allowed to hold.
And if your daily losses push the account equity down below that maintenance level,
The alarm goes off. The mechanism is triggered.
how are these numbers, the initial and maintenance margins, actually set? They can't just be arbitrary, given what's at stake.
Oh, they are far from arbitrary. They're dynamic, and they're primarily determined by one thing: the volatility of the underlying asset's price.
So if the asset is swinging wildly in price, the margin goes up.
Correct. The clearinghouses use sophisticated statistical models, often based on value at risk, or VAR, to calculate the largest expected one-day price move for that asset, with a very high confidence interval, like, say, 99%.
So the margin has to be big enough to cover the statistical worst-case scenario for a single day.
That's the idea. If crude oil volatility spikes, the exchange will raise the margin requirements to make sure the clearinghouse is protected. If things calm down, they might lower them.
But that creates a strange effect, doesn't it? Margin requirements go up precisely when traders are under the most stress.
It does. It's a phenomenon called procyclicality, and it can definitely make a bad situation worse for a trader who's already losing money.
And this brings us to that moment of dread for any futures trader, the margin call. So your account balance dips below the maintenance margin. What is the immediate, non-negotiable consequence?
The consequence is immediate collateralization. A margin call demands you deposit more funds right away, usually within 24 hours. And here's the key detail that people often get wrong.
You don't just top it off to get back to the maintenance level.
No, that would be too risky. The clearinghouse demands that you restore the account balance all the way back up to the original initial margin level.
Yeah, so you restore the full safety buffer?
A full buffer. And if you fail to meet that margin call, if you can't or won't deposit the cash, the clearinghouse has the right and the mandate to immediately liquidate your position. They close you out at whatever the market price is to make sure your loss doesn't become their problem.
And on the flip side, what if you're doing really well? Can you just pull your profits out every day?
You can, but only the excess profits. The withdrawal rule says you can only take money out if your account balance goes above the initial margin. That excess cash is your realized profit. You can take it, but the initial margin itself has to stay in the account as collateral.
So this whole system low initial collateral, the daily settlement, the immediate margin calls, this is the engine of leverage that makes futures so powerful, but also so dangerous.
It creates enormous financial leverage. I mean, you might only post, say, 3% of the contract's total value as margin, but you have 100% exposure to the price movements.
So your potential gains are huge.
Huge. But unlike trading options, where your maximum loss is just the premium you paid, in futures, your loss is, in theory, unlimited, and the exchange will force you to pay it immediately through that margin call mechanism.
This is where it gets really interesting. Let's stop talking in abstract terms and use some real numbers. Let's track a trade moment by moment and see the pain and the payoff of this daily settlement system.
Great idea. To really show how this works, we can track a short position in a commodity contract over 5 trading days. This will show exactly how collateral is tied to performance.
Okay, set the scene for us.
All right, our trade is a silver futures contract. The contract size is 5,000 ounces. That's our multiplier. The initial price, let's say on day 0, is $20 per ounce, and our position is short 1 contract.
So we're betting the price will go down. We make money if the price falls below $20.
Exactly. And to enter this trade, we deposit an initial margin IM of $3,000. The maintenance margin, the alarm bell level, is set at $2,500.
Okay, so we've put up $3,000, but we're controlling $100,000 worth of silver. That's 5,000 ounces at $20 an ounce. We're massively leveraged. Every $1 move against us is a $5,000
A
loss.
huge exposure.
Let's see what the market does. Let's go to day one. The market does not like our short position. The settlement price closes at $20.30 an ounce.
Ouch. That is an adverse move of 30 cents per ounce. You multiply that by our 5,000-ounce contract.
That's a daily loss of $1,500.
A loss of manic of $1,500. So we started with $3,000 in the account. We subtract that loss, and our balance plummets to $1,500.
That is immediate financial pain, and $1,500 is way below our maintenance margin of $2,500. The alarm bell is ringing.
It's blaring. A margin call is triggered instantly. The clearinghouse demands you deposit enough funds to bring the balance all the way back up to the initial margin of $3,000.
So since our balance is at $1,500, we have to deposit another $1,500.
Exactly. This is the clearinghouse preventing the loss from ever becoming its problem. If you can't post that cash by the deadline, your contract is liquidated. End of story.
Okay, let's assume we're good for it. We met the call, we deposit the $1,500, and our account is back at $3,000 to start day two. Now, day two, a massive reversal in our favor. The price drops all the way to $19.80.
Ah, fantastic news for a short seller. The price didn't just drop from the previous day's close of $20.30. It dropped $2.50. So we have a massive daily gain.
50 cents times 5,000 ounces. That's a gain of plus $2,500.
Right. So our starting balance for the day was $3,000 plus this $2,500 gain. That brings our account all the way up to $5,500. We've covered yesterday's loss and we're in the green.
Now what happens?
This is a great moment to talk about the withdrawal opportunity. Our balance of $5,500 is well above the initial margin of $3,000.
By $2,500.
That $2,500 is realized. Cash profit. It's yours. You are legally free to withdraw it from the account.
But for our example, let's say we leave it in there, just to keep the buffer high.
Good call. So we start day 3 with a healthy $5,500 in the account. Okay, day 3, the price retraces a little bit, settling at $19.90.
Okay, so that's a small move against us. From $19.80 to $19.90 is 10 cents.
A small adverse move of 0 10 cents, so that's a loss of net of $500. We started with that large buffer of $5,500. We subtract the $500, and we're left with a very comfortable balance of $5,000. No action needed.
Right, still well above the initial margin. Okay, day 4. The market sees a strong upward swing. The price settles at $20.40. That's a big problem for a short seller.
It is indeed. The price jumped 50 cents from the prior day's close of $19.90. So that's another painful loss of minus $2,500.
Our balance was $5,000, so that sharp drop takes us down to $2,500.
And look at that number. Our balance is exactly the maintenance margin. We are right on the wire.
No margin call, but we are extremely vulnerable. One more tick against us and we're in trouble. The efficiency of the system is so clear here, though. The exchange has just enough collateral to cover the loss up to this exact point.
And that further adverse movement happens.
Yeah.
Let's go to day 5. The settlement price just ticks up a little more to $20.45.
Another small loss. 5 cents an ounce. That's a total loss of negative $250 for the day.
A small loss, but it's enough. It pushes our balance of $2,500 down to $2,250.
And that triggers the alarm.
It does. Since $2,250 is below the $2,500 maintenance margin, a second margin call is triggered. The investor must immediately deposit $750 to bring that balance back up to the initial margin of $3,000.
Wow. This walkthrough really shows the immediacy of it all. I mean, that cumulative loss we saw is not some theoretical number on a screen. It is cash that was physically transferred out of the account.
Absolutely. The P&L is realized instantly. It constantly links your performance directly to the collateral you have on hand. It's how the system prevents debt from accumulating. Days 1 and 5 show how it forces immediate collateralization. The clearinghouse just cannot wait for tomorrow.
The genius of the system, then, is that it forces the individual trader to absorb all the price risk right now in cash. And by doing that, it creates this systemic environment of basically zero credit risk for the exchange and the wider market.
That's it. If the trader defaults, it's only on a single day's loss, which is covered by the margin, not on the entire $100,000 contract value.
Leverage is just... it's incredible. But before we get to the defensive orders traders use, we need to cover the final stage. How do you get out of one of these things?
Right, the exit strategy.
We've established the mechanics of the trade. But let's be realistic. If I've traded silver, the chances that I actually want 5,000 ounces of physical silver delivered to my door are pretty much zero.
Incredibly low. And that reflects the reality of these markets. The vast majority, we're talking well over 95% of all futures positions are closed out prior to maturity.
And you do that just by taking the opposite position.
It's that simple. If you are long one contract, you just sell one contract. If you're short, you buy one. The exchange nets your exposure to zero.
And you just walk away with whatever cumulative profit or loss you made from all those daily settlements.
That's right.
So then why do the delivery rules matter so much if almost nobody ever uses them?
Because the existence of the delivery mechanism is the essential tether to the real world. It is the possibility of final delivery that ties the futures price to the spot price of the actual asset as the contract gets closer to maturity.
Why is that so critical?
Well, think about it. If the futures price drifted way too high compared to the spot price right before expiration,
An arbitrage opportunity.
a massive one, an arbitrager could simultaneously sell the expensive futures contract and buy the cheaper physical commodity on the spot market, planning to make delivery. This activity, by itself, forces the prices back into alignment. It ensures that futures prices remain credible.
So even if it's rare, it's the anchor.
It's the anchor.
So if delivery has to happen, who kicks it off? And how does the clearinghouse match a specific seller with a buyer? I mean, you're not trading with one person anymore.
Right. Delivery is initiated by the short position, the party who is obligated to sell the asset. They get to decide when to deliver, within that specific delivery period we talked about earlier.
The seller dictates the timing.
Within the allowed window, yes. Their broker files a formal notice of intention to deliver. And for commodities, this notice details the exact grade and the specific delivery location.
And once that notice is filed, the clearinghouse steps in.
The clearinghouse steps in as the central counterparty. It has to select a long party to accept delivery. And the rule they almost universally use is to pass that notice to the party holding the oldest outstanding long position in that contract.
So it's first in, first out, essentially. That's a crucial point about the CCP's function. It's not just managing credit risk, it's managing the logistical risk of delivery, too.
Exactly. It guarantees performance and manages the matching. The long party is then legally obligated to accept that delivery, and they usually get a warehouse receipt or some other title document for the asset.
Physical delivery makes perfect sense for gold or cattle or oil. But what about contracts where the underlying asset isn't, a thing you can easily deliver?
That's where cash settlement comes into play. Many financial contracts, and even some complex commodity ones, are designed from the start to settle purely in cash. It removes the logistical headache completely.
What's the prime example of that?
The clearest example is any contract on a stock index, like the S&P 500.
Right, you can't deliver 500 stocks.
I mean, trying to deliver 500 individual stocks in the right proportions would be a logistical nightmare and incredibly expensive. So instead, at maturity, the contract just settles based on the difference between the final index level and your futures price. It's a single cash transfer.
A clean break. The obligation is fulfilled with money, not assets.
And we see this with interest rate futures too. They settle based on whatever the prevailing 3-month interest rate is at that time. It's just a cash flow to whoever made the right bet on the rate. It still maintains that critical link to the spot price, though. The reference price, the index level, or the interest rate, is defined with precision, and that's what anchors the value.
So the fact that these delivery mechanisms exist, whether they're physical or cash, is what makes these contracts valuable tools, not just bets.
It's what grounds them in economic reality.
Wait, you should go back to the massive leverage created by this margin system. As we saw in our silver trade, a pretty minor price move can wipe out 50% or more of your initial capital instantly.
And trigger a margin call?
Right. So this level of risk means that sophisticated risk management tools aren't just a nice to have. They are essential for survival.
That is the crucial final takeaway on mechanics. The system minimizes credit risk for the exchange by maximizing your price risk exposure. So you, the individual trader, have to employ defensive strategies.
And these defenses are built into the system through specific conditional order types.
Right. Orders that can automate liquidation when your risk limits are breached.
Let's start with the most important one for limiting loss. The stop order, or stop loss.
A stop order is designed to automatically get you out of a losing position. You specify a stop price. The very moment the market touches or trades through that price, your order is triggered and instantly becomes a market order.
So its primary purpose is to guarantee you get out.
It guarantees execution. You're sacrificing the best possible price for the certainty of getting out of a bad trade.
And that guarantee is critical if you're facing a margin call. You need to close the position now before the loss gets even worse. But using a market order means you can face slippage, right? Especially in a fast-moving market.
Exactly. And that's where the stop limit order comes in. It's a hybrid. Like a normal stop order, it's triggered when the market hits your stop price. But instead of becoming a market order, it becomes a limit order.
So you're saying, get me out, but don't sell for any price worse than X.
Precisely. You're protected from extreme slippage if the market crashes through your price. But what's the trade-off?
The trade-off has to be certainty.
Certainty of execution. If the market moves too violently and gaps past your limit price, your order might simply not get filled. You're left holding the bag, still exposed to a market you wanted to exit. It's a strategic choice every trader has to make.
Beyond just controlling the price, traders also need to manage how long their orders are active.
Right, the lifespan of the order. The default for a lot of strategies is the open order, or what's often called a good till cancel GTC order.
And that just stays on the books.
It stays active on the exchange's order book until it's either executed, you cancel it, or the contract itself expires. People use these for long-term price targets or protective stops they want to keep active for days or even weeks.
And the complete opposite of that, when time is absolutely critical,
That would be the fill or kill order, or FOK. This order demands immediate and complete execution. If the entire size of your order can't be filled instantly, at your price or better,
the whole thing is canceled.
the entire order is killed. These are critical for big institutional traders who need to move large blocks quickly without leaving partial fills hanging out there and tipping their hand to the market.
So understanding that the margin system creates the risk, and these order types are the critical tools to manage that risk, that's really foundational.
You have to manage your collateral exposure moment to moment, or the exchange will manage it for you, and usually at the worst possible time.
We have really mapped the essential DNA of the futures contract today. We've seen how standardization creates the uniformity the system needs to be efficient.
And how that rigorous daily settlement process isn't just bookkeeping. It is the core mechanism that strips away counterparty credit risk and makes the whole market liquid. And the so what here, it can't be overstated. By enforcing these standardized specs, introducing massive leverage with low margins, and demanding daily cash settlement, the system defines the risk profile of futures.
It minimizes default risk for the system as a whole.
Right, for the clearing system. But by doing that, it pushes the full weight of the price risk, which can be amplified dramatically, right onto the individual trader's shoulders.
The daily mark-to-market system forces instant, uncompromising accountability. And the possibility of delivery, even if it hardly ever happens, is still the structural anchor that ties the derivative price back to the real-world spot price.
The system is, it's structurally brilliant at isolating systemic risk. But by getting rid of the primary risk that banks and institutions face, which is credit default risk, it shifts the entire responsibility for staying solvent onto the individual.
And when you look at financial history, every major trading scandal or blow-up seems to stem from individuals who either misunderstand or just deliberately ignore the immediate demands of daily settlement and margin calls.
That's almost always at the heart of it.
So, as we wrap up, consider this provocative thought. The futures market is designed for systemic safety and efficiency, but it requires continuous, hyper-vigilant risk management from you, the individual. Given that today's contracts are so well-defined, what happens when that standardization fails? Or what happens when a sudden, violent price event, a black swan, causes such extreme illiquidity that even the best stop orders can't execute?
And market participants just can't get their hands on the cash they need to meet their immediate daily margin obligations.
That gap, the gap between the collateral required and the capital that's actually available, that is always where the next major market challenge is going to come from.